And joining us now for more is Morgan Stanley financial advisor George Noceti. George, good to see you. Thanks for taking a couple minutes.
Yeah.
What did you make of this jobs report out today?
Well, you have to think of what the baseline is. The economy needs 150,000 new jobs every month, and that accounts for people leaving the workforce and the young kids coming into the workforce. However, over the past 12 months, we've been averaging about 168,000 new jobs each month. So this is really a decline from that, plus the unemployment rate ticked up a little bit. That's another indication that the economy might be slowing. And when the economy slows, that can cause the Federal Reserve to really lower the lending rates, which would help tick the economy back up again.
Because then people would be more apt to maybe buy a car, get a car loan, buy a house, get a...
Yeah, loans would be cheaper. The mortgage rates, if the 10-year bond comes down, which it has been a little bit, that'll help reduce the interest rates from the high level that it is right now. But the Federal Reserve is clearly looking at this, yeah.
I'm sorry, is it clear that the new administration has affected the economy already, or is that hard to say?
Well, it's 2 months into the new administration. So, but however, there are some reports, like for example, the University of Michigan confidence report shows that consumer confidence is down 10% in the past 2 months, and it's important that consumer confidence be high, because if your confidence is high, then you are going to take a loan out to buy a car because you're going to have a job long term. But confidence is down, and also this whole tariff debacle that has happened really shows policy indecision, and that affects consumers in terms of buying, whether they're going to buy or not, and that affects companies that are really planning expenditures and spending. That affects developers who are wanting to build tract housing, and they need lumber and they need permits, and so these things, the indecision in the policies really reduce confidence from a business perspective and from a consumer perspective.
What do you make of this week's on again, off again, maybe lumber in certain aspects of this this tariff situation this week?
Well, it's not good. It's not good because it looks like, when the tariffs were first talked about, they were pretty severe. And then when it came down to implement them, there was a back off. So we're off again, on again, off again, on again. It's shock and awe, but there's not consistency yet. Maybe there's a strategy behind that. But when that happens, again, that stops manufacturers and developers from really having, future plans going forward, because they really don't know what their costs are going to be. So if this turns out to be more of a moderate tariff, that'd be really good, because the Federal Reserve will be looking at that in terms of lowering their lending rates. And if they see moderate tariffs, if they see, again, another weak job report, which would motivate the Federal Reserve to lower the lending rate, and if they see declining inflation, then the market has baked in, if those things happen, the market will bake in the Federal Reserve lowering the lending rate in June, July, and August. That'll help stimulate the economy again. But the Federal Reserve is in no hurry to do that. And Jay Powell today, the Federal Reserve chief, said they're going to wait and observe and see what happens with tariffs. It's the first time he's mentioned the word tariff, so it's kind of interesting.
Yeah, it's got to be on the radar now. Today, the Treasury Secretary, Scott Bessent, said on CNBC, the market and economy have become hooked, become addicted to excessive government spending, and there's going to be a detox period, which, detox, you could put your own definition on that. What do you interpret that to mean?
Well, because of COVID and the market stopping on a dime several years ago, we infused the economy with a lot of cash. We're still working through that. And so lending rates were low. There was a lot of leverage out there. And the question is, are the companies profitable enough to absorb all that? And that's why you're seeing another market decline, the past couple of months, because stocks have been overpriced. Tech has led the way. And now there's kind of a pullback from tech. Artificial intelligence is going to be there. It's going to be largely effective. But is it having productivity right now? So the companies aren't as productive, and they're very expensive. And so that's why if people were invested, let's say in the S&P 500 the past 2 months, you'd be down about 1.85%.
Right.
The Dow is down over half a point, and NASDAQ is down 6%. So you would be down. But if you had fixed income in there, if you were diversified, fixed income's paying about 5-6%. You'd probably be positive year to date. So a lot of it is really how you are asset allocated. to benefit from the market and making tactical decisions along the way.
All right, last one real quick. You have a
Sure.
401k. You've seen it go down the past month for sure. When should you worry about that?
Well, this is the diamond in the rough for people that have a 401k. 401ks are long-term investments for retirement. You get penalized if you take money out early. So just think about this. You want volatility. You want the market to go down because out of your paycheck each month, you're buying mutual funds at a low rate, at a moderate rate, and at a very high rate. When would you rather buy these mutual funds? You don't want to buy them when the market's on fire and doing great because they're really expensive. You can't buy as many mutual funds. So if the market tends down, this is a great opportunity to buy low. And because you're not going to be turning it around in a week or two or a month, you're going to be holding it long term for your retirement, then your portfolio should really make money for you.
All right, we'll leave it there. George Noceti, Morgan Stanley financial advisor. Always appreciate your time. Have a good weekend.
All right, Grant. Have a good weekend.
All right.
Thank you.